guys. Welcome to the show. Glad to have you guys here. Now today, listen, I'm back in my home studio, and I'm happy to be home here in Halifax, Nova Scotia, Canada, and up in New England. And I'm glad to be back in New England, in the New England area. And listen, here's the thing: asset bubbles. We've got these enormous bubbles that they've blown up. We've got an enormous real estate bubble in Canada. It's terrible bad. It's just starting to burst. Out in the western parts of Canada, the home prices have already fell by 1%, basically. So, but that's the starting of the burst. Now, the thing about asset bubbles is when they actually start to pop and burst, they gain a certain momentum, and they burst very quickly. And it's hard to stop that momentum, that downward spiral. It takes an awful lot of energy to push it back up. To blow the asset bubbles back up again takes equal amount of energy as what it takes to get them going to start falling in the first place. Once they get started, they're starting to pop. And the reason why they're starting to pop is all these months and months and months that the Fed has done quantitative tightening. It's starting to finally show its effect in the everything bubble, basically. That's what they call it, the everything bubble. Now, in the United States, we see that an awful lot of people are delinquent on their car payments now. Millions of people are delinquent on their car payments. This story's going underreported. This is billions of dollars going to be lost into the economy. But that's just the beginning. It's the tip of the iceberg. What we're going to do is we're going to open up the charts and take a look at the biggest asset bubble of them all. The one that's starting to burst, and when it bursts, look out below. Now, we got an awful lot of other problems in the financial system that I'm going to be delving into later, but this is a biggie. This is a really big problem. Let's get started, and let's open up the charts right here and take a look. Signs that the Chinese real estate bubble is going to burst, and it's going to take the whole world's economy with it when it goes. Home sales are falling in China. The total housing area sold on a year-to-year change is right here on this chart, and we can see that it's dropping. In January, it's dropping precipitously and fast. The problem now, this article is such a good article. I think I'm going to actually, normally I don't read the whole article, but I think I'm going to read this one because it's such a good article. It says China's real estate bubble is the largest in human history. So it's bigger than what caused the 2008 financial crisis. This is bigger. And despite years of warning signs, it has grown, and it has grown, and it is spilling over into the rest of the world. It's hard to overstate just how crazy China's real estate market is. 25% of the country's GDP, their gross domestic product, comes from construction on this real estate bubble. 25% of their country. It says 80% of the nation's wealth is in these domestic property holdings. 80% of the Chinese wealth. That's $65 trillion. Nearly double the size of the economies of every G7 nation combined. Can you imagine what's going to happen when this thing bursts? The market has been kept afloat through China's massive shadow banking system. Now, I did an article not long ago on the shadow banking system in China. Itself, this shadow banking system, is such a systematic risk that the Chinese government has been forced to crack down on it. Now, China's massive blue-chip property developers have had their debt downgraded to CCC by these companies like Moody's or whatever, that it says right here, they're struggling to issue new bonds. Moody's rates the debt of 51 of the 61 Chinese property companies as junk. This is what's happening. The ratings agencies are rating it all as junk. Junk. China has 65 million vacant homes. Now, I've talked about these on other shows. These homes are not getting repaired or anything. You've got things like the water's not hooked up, electricity's not hooked up, nobody's living in these homes. You've probably got rodents running around in there and chewing on the walls and everything else. Gosh knows what. But these properties are assessed right now at these tremendously exorbitant prices because this is a bubble. And the Chinese people have bought in, and they've bought in big. It says China has 65 million vacant residences, but prices remain stubbornly high. So these prices are high because buyers are still coming in with this cheap money. But now the money's starting to deflate away, and the first thing you know, bubbles, like I say, when they pop, they go fast. And so this thing could go down awfully fast. It says even in the tier 2 cities like Juan, where a 1,000 square foot apartment costs renminbi 2 million. Now, what is that in our dollars? More or less, well, these Chinese, it says here, they only earn renminbi 6,000 a month. It's not, a renminbi's worth less than a dollar, considerably less than a dollar. But they only earn 6,000 a month, but it's $2 million to purchase one of these apartments. But evidently, they've been purchasing them like mad, you know, and these apartments, like, it's ridiculous. The whole thing is actually ridiculous. It says this has tanked sales volumes down to 44% year-on-year in the first week of 2019, but developers are not able to lower their prices in the face of popular uprisings from people who have over-leveraged themselves to buy into these Tier 1 city markets. In one case, a cut to the price of unsold units sent the Shanghai people, Shanghai property owners, into the streets chanting and holding up signs saying, give us our hard-earned blood and sweat money back. The nation is staggering under a massive real estate debt, $3.4 trillion worth of it, and 41.7 of that is tied up in vacant properties. And the people who borrowed that money are not receiving rental income, nor are they living in these properties. The banks that lent that money could face a massive wave of defaults. Renmin University professor Zhang, I'm not going to try to pronounce his last name, Song Zhu. Okay, I tried to pronounce it. Okay. He has called this the Minsky moment. The Minsky moment is a phenomenon coined by Hyman Minsky to describe how an asset class can rise steadily in value before suddenly collapsing. So that's the bubble bursting, basically. In response to the property slowdown, some local governments have been quietly removing some restrictions on home purchases, including scrapping price caps for new units and relaxing the requirements to non-local buyers. In early January, China's central bank also moved to lower the amount of cash that banks must hold as reserves by 100 basis points, freeing up a net of 800 billion yuan, or 117 billion for new lending. But economists and analysts are skeptical about the effect of these easing measures. Well, I'll tell you what the effect of these easing measures are going to be. They basically freed up $117 billion for new lending for these homes. This will keep it going for a month or two more. But you know, a month or two from now, everything else is going to start to roll over in the world. We're going to have the Brexit. We're going to have possibly Deutsche Bank. We're going to have Italy starting to get in more trouble, need more money. Everything the Canadian real estate bubble is probably by then. Right now it's 1% down. It'll probably be 5% down by then because it's bursting rather rapidly too. You know, and so we got all these other problems coming due in a couple more months. So this whole thing, they got $117 billion, probably going to last them a couple more months. So it says economists and analysts are skeptical about the effect of these easing measures. The broad attempt to reduce risks in the financial sector has been the main reason for the slowdown, said Sean Roach, Asia-Pacific chief economist at the S&P Global Ratings. Deleveraging is considered to be the critical battle. Policymakers are easing, but only carefully, he said in an interview. Alan Zinn, head of non-Japan Asia company, researched at Mizuho Securities said the easing measures are fairly trivial and not likely to stimulate much more new home buying. The most draconian period in the debt policy front may be over, but this by no means indicates that developers can look forward to rosy days ahead in 2019, he said on January 10th in a research note. So what's happened is China, through the shadow banking system, through a lot of investment money that they got through tremendous amount of stimulus measures by the Chinese central government, they've went whole hog into real estate. And they've basically built ghost cities. Nobody's living in apartments that go to nowhere out in the farmers' fields and stuff like that. It's quite seriously, they haven't even put any asphalt to them, no electricity. They're just sitting in the middle of a farmer's field. The high-rise goes up like way up there, like 500 feet high. It's all loaded with apartments, and all those apartments are sold at extremely extravagant prices, and there's even no place to even park unless you're going to park a tractor, you know? And this whole thing is a Ponzi scheme. It's getting ready to pop. It's right on the verge. They've kept it going through stimulus measures and everything else up till now, the Chinese have. It's all ready to pop. But the problem is, that alone can bring down the world economy, but the problem is there's so much more out there to report on. All of it, it seems like this is the perfect storm. Everything's coming due at once, all simultaneously. And I'm going to tell you, we've made it through. A lot of people have got, because we've made it through such a long period now, when everybody said, okay, it's coming, it's lasted a little bit longer. It's taken a little bit longer to get here. But the perfect storm, financial speaking, is the sky's starting to get dark now. And nobody's taking any notice anymore. Listen, thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye, guys. Oh, and I'm glad to be home.